Good afternoon. I'm Chris Swift. On behalf of my partner, Chris Wimard, and our General Office Manager, Sean Gammon, thank you and welcome to this edition of Shooting the Bull. We got quite a bit to discuss this afternoon because over the weekend, we become more and more thinking that expansion is really taking place. Somewhere probably in January and February, we halted all the liquidation. Now we're starting to expand. And as the numbers, slaughter numbers come in from August through the rest of this year, we'll kind of know whether or not if heifer retention has really started because we'll have fewer heifers slaughtered in there. So with that, we noticed that over the last 2 weeks, we've had an enormous amount of price expanse and volatility in the market to limit down days, one on last Thursday and another one on this past Friday. With that, we also believe that there's been an enormous shift in the open interest of who owns those long positions or short positions now at the top of the market. Going forward, we have created a rather large positive basis in both the feeder cattle and the fat market. And it has been there in the fat market for quite a while, but it's a new development in the feeder cattle market. We have been able to stay relatively close to the index, and sometimes we even jockeyed a little bit above it, creating a negative basis for a short period of time. After Friday's big decline, we opened up the basis to the back end to as much as $19 to $20. Now we have to contend with that with two factors. If expansion has really begun, a lot of those heifers will be dropping calves in the March, April, May timeframe of 26. I understand that those cattle are not going to be anywhere closely remotely ready to go into cattle production or beef production, but we also have looming the Mexican border. I think it is possible before the end of the year, we have the border open and running at a relatively smooth pace, creating a tremendous amount of inventory right off the bat, ready to go on feed, or maybe with just a little bit of backgrounding. And then we have started expansion. The spring of the year, we'll have more and more cattle coming. So it is possible that by this time next year, we could be exponentially larger in cattle production than what we have been. So we got to get out in front of that curve. If you believe that the cattle prices are going to continue to go higher, how much higher? I don't have any idea. We have a basis to contend with, and for our backgrounders, it's probably going to make it the most difficult to manage because what we're going to look at is what took place and what incentivized corn farmers over the last several years to plant as much corn as what they have this year, and that is price alone. In 2022, the corn market for December was trading at $7.50 a bushel. On that same day, the 23 contract was trading at $6.75, 75 cents under. On that same day, the 24 contract was trading at $6.02, 73 cents under. And at the same day, the December of 25 contract, $5.77, that is down $1.73 from the April of 22 contract to the December. And when we look at today, corn closing at 407 and 3/4, there was $1.70 to be made, having sold futures 3 years out in front at $1.73 discount. Do not think that cattle cannot produce the exact same thing. We have seen repetitively the last 6 to 12 months, new contracts coming on the board. Those were the contract lows, and the market has done nothing but gone straight up since. It is possible, starting with the September contract, September of 25 goes off the board. September of 26 could be looking at the contract highs. And it is very possible that we could decline all the way into September of next year. And I do realize that most everybody's saying there's no way to, especially with expansion starting, because that's going to pull more heifers out of the mix. No doubt, it already is. We can already see that, and the market knows that as well. But it continues to allude to those Mexican cattle that are across there that at any given time they come over, we could see an enormous break in the market because the only issue we have now is cattle supplies, not beef production. Beef production has risen. It has remained greatly higher that even at a negative under year over year, it is significantly higher than what the loss of cattle have been. So we have been able to increase beef production significantly. It's cattle production that we've been shy of, 800,000 head of them across the southern border, and now we're beginning expansion. We're going to have to get in front of this curve. There's a couple of ways to go about doing it. All of it are going to cost money. There's no way out of this. And in the spring of the year, when I started talking about how much working capital is going to take, I had no idea that not only was it going to be this much, but it was going to take even more once we turn the corner. Once we turn the corner and start down, you're going to see more and more people want to hedge, and they're going to be hedging at a slightly better discount, slightly more discount than what they are today. So again, trying to get this on the front end of it is going to be very crucial in what our marketing price is going to be going forward. So the first thing you look at is just an option. Just going to buy the at the money put option. Going out in the spring of the year, that could be anywhere from 5.5 to 6.5% of the value of the contract. Not only that, you're already got a $17 discount to the futures over the index. That is your worst case scenario. I know exactly what my minimum sale floor is going to be, and I know exactly how much dollars that I've got put out. It produces a very low minimum sale floor to you. The next may be a bear put spread. You can buy the at the money put and sell the put option down below, create a window of opportunity. A lot of times the premium still that you have to pay eats into a lot of the width of that window. You can sell a futures contract and buy a call option at the strike level of where the index is trading at today, the 340. You still are going to lose the basis regardless. And your worst case scenario would actually turn out to be if the underlying futures contract meets and converges with the index at today's level of 340. Because not only did you lose the basis, the futures went up and closed the basis, you lost that, but you lost 100% of the option premium too. So that's a bad situation right there, in my opinion, of having to assume the basis and still an option premium that you may or may not get back. If you look at it from the business standpoint, there is no better way to manage this market than with a fence option. You buy the at the money put and you sell the call that is at the strike price of the index. Now, the futures market can go all the way up to the index level, and you're only going to lose the premium that you paid for the spread in the option. Once above the underlying short futures call, then it works just like a futures contract. You are short the market at that level with unlimited margin calls and unlimited money that you're not going to make to the upside. Your cattle will continue higher, as we have already seen that take place, and there has been zero instances where convergence of basis has not taken place. It has taken place. It just depends on where it takes place. And we know that some of the great frustration has been not having made a lot of this price rally because we sold the short calls, we've sold futures, we did things that limited our upside. We're close to $80 higher since most of those recommendations were made at the first of the year. Are we looking for another $80 higher? It's possible. Something to think to make that there's no top to this market. I can almost assure you at some point in time, there is a top to this market. And with the new fundamentals coming about, it may be a little sooner than later. So consider what you may have to be doing. You may have to start looking at marketing inventory. The second that you get it bought, you may have to be looking at marketing out at a discount, and that be your absolute highest price that you could have ever achieved to begin with. So consider those factors that we're going forward, and lenders probably the ones the most, because we know that lenders have had to finance a tremendous amount of this margin requirement that has been everybody, and there has not been a broker or an analyst out there that has recommended a short position that has been right up until last Thursday. So we're looking at lenders that have had to make months in of margin requirements for their clients, seeing that some of those clients were unable to make as much as what they possibly could. Others just assumed all the risk themselves and were able to make large windfalls. In my opinion, you'll see those same ones that did not use the risk management on the way up, they will lose the majority of it on the way down. It's very difficult to pick a top in this. I'm not saying that this is a top in any way, shape, form, or fashion. I'm just saying that there is evidence out in front of us of 800,000 head of Mexican cattle that could open the border at any given time to. And we have great ideas that expansion is taking place, and even better ideas that the dairy beef cross is growing and putting the number of cattle on feed out there instead of like what we're seeing right now in the beef, where we're going to be pulling more heifers out because we're going to try to expand. So we're in a really difficult situation. We're kind of here at a turning point. Even if it may not be a turning point in price yet, it's probably close enough to start having to have these difficult conversations. All right, we've had a really good first 8 months of the year. What's the next 4 months are going to be before the end of the year? And then we got all of 26 to contend with some of the highest animals that we bought this month that we really won't be marketing until this next year, or bought sometime through the summer that we won't be marketing to the next year. So it's nowhere near over with. You got a lot of work in front of you. Consider what some of the things that are available to you, and then call us, see what it is that you need to do, and we'll help you work through, regardless of what it is. We can post most any futures contract or options and pretty much tell you what the end result is going to be, regardless of whether the market is higher or lower. It becomes your determination of a couple of factors. One, who do you want to assume your risk? You, or do you want the market to assume it? If you want the market to assume it, how much of it? Similar to the deductible on your truck. If you got a $60,000 truck, do you insure for 60,000, 50, 40, 30, whatever that case may be? Those are decisions that you're going to make depending upon what you think the value of that catalog. And your last and probably foremost of it is how much are you willing to pay for that? That's where your lender comes in, because some of this stuff is going to be relatively expensive. It's going to take more cash out of your pocket. And as capital intensive as cattle production is right now, you're going to need more money. So lenders are going to have to really perk up here and get some knowledge of how the futures are going to work, how any of the spreads that you decide that you put on or outright is going to work, and then help them to finance it through fruition. Because up to today, we can see that whatever we missed out on, the convergence of basis repaid the client and or the lender with the proceeds from the cash sales of whatever they missed out on the futures. Take a good look at it. Give us a ring. If you have any questions, we'll be more than happy. Read our commentaries on shootinthebull.com or swifttradingco.com. Feel free to give us a ring at any time, 615-844-2206. Thank you very much.